In the boardroom, numbers tell stories. And in risk management, those numbers tell us how much uncertainty we can afford. Quantitative risk metrics translate complex risk into measurable insight. The language of governance, capital, and resilience. In a world where data drives decision, boards can't rely on instinct alone. They need metrics that quantifies exposures, predict impact, and connect risk directly to financial performance. That's what quantitative metrics do. They turn risk into numbers and numbers into strategy. Welcome board. We will be looking at quantitative risk management metrics in this part of the video. This is part of the series on taxonomy on risk management space. So, in the boardroom, numbers don't just measure performance, they reveal resilience. Quantitative risk metrics turns uncertainty into insight and data into governance. Value at risk shows the maximum loss we could face, while conditional VAR reveals what happens when the worst actually occurs. Stress testing and scenario analysis simulate how we survive under pressure, from market crash to cyber attacks. Capital adequacy ensures we hold enough to absorb shocks, and RAROC aligns profitability with the risk we take. In credit, PD, LGD, and EAD quantify exposures, showing who might default, how much we would lose, and what's at stake. And in cyber and operational risk, we have ALE, SLE, EF, ARO, and RRF, which translates threat into financial terms. Because for the board, risk quantified is risk controlled. And in today's world, clarity is the highest form of resilience. This is your host, Savit Vittal Salian. We are at part 7 of this series. So, welcome. The agenda for the whole series is as shown, and the specific topics that we would cover for this part of the video is as listed. Financial and operational metrics. Value at risk. It's a statistical measure that estimates the maximum expected loss over a specific time horizon at a given confidence level. Example, at 95% confidence, the maximum daily trading loss is $5 million. A VAR is used for calculating capital reserves for trading desk. A VAR can be used to compare risk exposure across the portfolio. It could also be used for supporting regulatory reporting, or is used for stress testing financial resilience under adverse scenario. VAR estimates the maximum loss the organization could face under normal conditions, given the board's visibility on the potential downside. Conditional value at risk or CVaR. This is the average expected loss in the worst case scenario beyond the VAR thresholds. Example, its average loss in the worst 5% of the days is 8 million. This is an example. CVaR is used for providing a more conservative estimate of tail risk. It's used for improving portfolio risk management in a volatile markets. It's used for supporting insurance and reinsurance risk pricing. It is used to meet stricter regulatory capital requirements. Conditional value at risk is a measure which measures average loss in extreme scenario beyond the VAR, ensuring the board understands the tail risk. Stress testing. It's about evaluating how portfolio, operations, or system perform under extreme but plausible adverse conditions. Example, testing banks' capital adequacy under a 30% market crash scenario. Stress testing is used for regulatory submissions. It's used for testing IT systems resiliency against cyber attacks. It's used for evaluating liquidity under credit crunch scenarios. And it is used for supporting recovery and resolution planning. So, stress testing simulates performance under extreme but plausible scenarios, helping assess one's resiliency. Scenario analysis. It's a forward-looking technique that evaluates the impact of different hypothetical scenarios on risk and its outcome. Example, assessing the impact of a geopolitical conflict on global supply chain and forex exposure. Scenario analysis is used in analyzing the ESG and climate related risk. It is used for evaluating regulatory change impact on compliance cost. It is used to assess cyber attack scenarios on financial operations, or it could be used to develop crisis management playbooks. So, scenario analysis evaluates the impact of what if events to prepare the organization for multiple futures. Loss event database. It's a structured collection of historical internal and external risk events with impact and the frequency data. Example, recording ATM fraud incidents for say 200,000 loss. System exploited via skimming example. So, loss event database is used for trend analysis of operational loss. Loss event database is used for benchmarking against industry losses or support capital allocation for operational risk. Loss event database helps to validate the risk model using real world incidents. So, loss event database tracks historical risk incidents and its losses, thus enabling the board to learn from past failures and benchmark against peers. Capital adequacy. It's a measure of whether an institution holds sufficient capital buffer to absorb potential losses. Example, bank maintains tier 1 capital ratio of 12% versus the regulatory minimum of 8. So, capital adequacy is used to satisfy the Basel III, RBI or ECB requirements. Capital adequacy could be used for maintaining investor and depositors' confidence, or could be used to support credit rating and funding cost. Capital adequacy aligns with the internal capital adequacy assessment process. Capital adequacy confirms whether the organization holds enough buffer to absorb shocks, thus reassuring regulators and stakeholders. Risk adjusted return on capital. Well, it's a metric comparing returns to the economic capital required to absorb associated risk. Example, a project would yield 15% ROI but only 9% risk adjusted return on capital after accounting for risk. A ROC is used for evaluating profitability versus risk in lending investments. It is used for comparing business lines on risk adjusted basis, or it's used for optimizing capital allocation decisions. It helps to support board levels risk return trade off discussions. So, risk adjusted return on capital ensures business returns are measured against the risk taken, aligning profitability with sustainability. Probability of default. Well, this is the likelihood that a borrower or counterparty will default within a given time horizon. Example, borrower has a 2% 1 year probability of default on credit rating. So, probability on default is used to calculate the expected credit loss, or it's used to feed into credit risk model and rating systems, or it could be used to support loan pricing decisions, or could be used for monitoring counterparty risk exposure. So, probability of default provides the likelihood of a counterparty defaulting, which is key for lending and investment oversight. Loss given default. It is the proportion of an exposure that will be lost if a borrower defaults after recoveries. Example, 1 million loan default, recovery is 400, so the LGD is 60%. LGD is used for quantifying the potential credit portfolio losses. It is used for supporting Basel II, Basel III capital requirement. Loss given default is used for would feed into credit pricing and provisioning model. LGD could be used for guide collateral and recovery strategy. So LGD estimates the portion of exposure lost if default occurs, informing credit and capital planning. Exposure at default is the total value a bank or institution is exposed to at the time of borrower's default. Example, a credit limit line of 10 million with a 7 million drawn at a default EAD is 7 million. So EAD is used to calculate regulatory capital for credit risk, could be used to determine maximum potential exposure in counterparty defaults, could be used to support credit decision making, or align with IFRS 9 and Basel III requirement. So EAD shows the total value at risk if a borrower defaults, helping board assess the true risk exposure. Annualized loss expectancy. Well, this is the expected loss, annual loss from a specific risk, calculated as a single loss expectancy multiplied by the annualized rate of occurrence. Example, a data breach of 1 million expected once every 10 years is equal to 100K. That's your ALE. So, ALE is used for prioritizing cybersecurity investment by cost benefit. It is used for comparing risk in monetary terms for board decisions. ALE is used for support cyber insurance premium assessment. ALE used for benchmarking cyber security return on investment for mitigation control. So ALE quantifies expected yearly loss from cyber or IT incident, turning technical risk into financial terms the board can act on. Let's look at cyber and IT risk metrics. Single loss expectancy. Well, these are the financial loss expected from a single occurrence of a risk event. Example, a ransomware attack leads to 500K in recovery and downtime cost. So, single loss expectancy is used for quantifying impact of individual IT incident. And SLE is used for supporting decision making for backups and recovery solution. A SLA could be used for estimating insurance coverage per event, or it could be used to build loss scenarios in risk register. So single loss expectancy is estimating the financial loss from a single event, thus supporting board decision on insurance and continuity planning. Exposure factor. Well, it is the percentage of an asset's value lost due to a specific risk event. Example, a cyber attack damages 40% of a 2 million database. So, exposure factor would be 40%. Exposure factor is used to quantify severity of cyber events. It feeds into SLA and ALE calculations. It supports scenario analysis for business continuity planning, and it helps inform IT control prioritization, whether it is patching or DR. So, exposure factor expresses the percentage of an asset's value that could be lost in an incident, making risk impact tangible. Risk reduction factor. It's a measure of how much a control reduces the risk exposure compared to an unprotected state. Example, installing DDoS protection reduces the risk by 70%. So the risk reduction factor is 0.7. RRF is used for demonstrating the return on investment of cybersecurity investment. It is used for comparing control effectiveness across vendor. It helps support regulatory compliance evidences and help provide board level justification for resilience spending. So, risk reduction factor demonstrate how much risk is reduced by controls, helping boards evaluate the return on investment of resilience related investments. Annualized rate of occurrence. This is the estimated frequency with which a risk event is expected to occur within a year. Example, phishing incidents expected 3 times per year. In that case, ARO would be 3. ARO is used for estimating the frequency of cyber attacks for risk modeling. ARO is used to support calculation of ALE, that is risk quantification. ARO is used for benchmarking incident rates against peers. It is used to track effectiveness of awareness training programs. So, annualized rate of occurrence shows how frequently a cyber or an IT event is expected per year, linking directly to board oversight of for preparedness. So, in summary, let's begin with value at risk or VAR, the cornerstone of financial risk measurement. It estimates the maximum potential loss over a given time frame at a given confidence level. It tells the board this is the most we could lose 95% of the time. But what about the other 5%? The tail risk. That's where the conditional value at risk or CVaR or expected shortfall comes in. It measures the average loss in the worst case scenario, providing a fuller picture of vulnerability when market or event moves beyond the expected. Then there's stress testing and scenario analysis. It's forward-looking tool that simulates how the enterprise performs under extreme or hypothetical conditions. Whether it's a market crash, a cyber outage, or a regulatory shock. Stress tests reveals not just if we can survive, but how. The loss event database gives a historical grounding, capturing internal and external loss incidents to benchmark, learn, and improve. Each entry is a lesson, not a failure. Capital adequacy ensures that even in the worst condition, we hold enough buffer to absorb the shocks. A question every regulator, investor, and board members care about. Risk adjusted return on capital or RAROC then connects the dot. It aligns profitability with the risk taken to achieve it. It helps the board balance ambitions with accountability. So, when it comes to credit risk, the trio of PD, LGD, and EAD forms the foundation. The probability of default or PD measures the likelihood a borrower will default. The loss given default or LGD tells us how much we would lose if that happens. The exposure at default or EAD shows how much we actually exposed to. Together, they bring transparency and precision to lending and portfolio decisions. And then we have the cyber and operational risk metrics, translating digital threats into financial terms. The analyzed loss expectancy or ALE combines the single loss expectancy and annualized rate of occurrence or ARO to estimate yearly exposure. The exposure factor or EF shows the percentage of asset value at risk during an event. The risk reduction factor or RRF measures the effectiveness of the control or how much risk our investments actually eliminate. So, for the board, quantitative metrics are not about precision alone, they are about perspective. For the organization, they turn uncertainty into evidence and judgment into informed choices. They ensure every risk decision the organization is taking is backed by data, not just intuition. Because governance isn't only about what could go wrong, it's about how much we can endure, how fast we can recover, and how wisely we invest to stay resilient. In the language of the boardroom, Risk quantified is risk controlled. With this, we come to the end of this part of the video series. We covered the quantitative risk metrics. We will now move to part 8, which is the risk process. I would like to thank all who have stayed with me till now. This is your host, Savit Vittal Salian. Namaskar.